Key Risk Management Techniques Introduction. Welcome to Key Risk Management Techniques, one of the most critical aspects of trading success. While identifying profitable trades is important, protecting your capital ensures you stay in the game long enough to grow. Today, we'll cover 4 essential techniques: position sizing, stop-loss orders, risk-reward ratios, diversification, and leverage control. These techniques will help you minimize losses, manage risk, and build consistency in your trading. Section 1. Position sizing. What is position sizing? Position sizing determines how much of your capital to risk per trade. The golden rule: never risk more than 1 to 2% of your total account on a single trade. Why is position sizing important? Prevents significant losses from a single bad trade. Example: with a $10,000 account, risking 2% means $200 per trade. Even if you lose 10 trades in a row, you've only lost 20% of your account. How to calculate position size? Formula: position size equals risk per trade, stop-loss distance. Example: account size $10,000, risk 2%, stop-loss 50 pips. Adjust lot size to ensure a $200 loss at 50 pips. Section 2. Stop-loss orders. What is a stop-loss? A stop-loss automatically closes a trade at a predetermined price to limit losses. It's your safety net when the market moves against you. How to place a stop-loss? For buy trades, place the stop-loss below support levels. For sell trades, place the stop-loss above resistance levels. Benefits of using stop-loss: prevents emotional decision-making when the market drops. Protects your account from large drawdowns. Example: buy your USD at 1,1200. Set a stop-loss at 1,1150, 50 pips below. Pro tip: use ATR average true range to calculate dynamic stop-losses based on market volatility. Section 3. Risk-reward ratio. What is a risk-reward ratio? It's the relationship between potential profit and potential loss. A typical target is 1:2,